international future effect, if interest rate is higher, it's because of inflation. So if interest is higher in that country, its currency should go down, and that should be reflected in our exchange rates as well. So you will be ended up earning the home interest rate if you are not covering your position. So that's why covered interest arbitrage is that you play with the interest rate differential and then you cover your position so that you can earn riskless profit. There is no risk. So thus the arbitrage tends to allow for more orderly foreign exchange market. So there is no drawbacks of arbitrage. It's a good thing that people discover it and exploit the opportunity, and that acts as a goodness in the market as to make the market more efficient. So here is that we play with the locational arbitrage between the locations. Triangular arbitrage is between the currencies and the cross exchange rate, and covered interest arbitrage we play with the interest rate differential covering our position with forward contract. Okay, now we will talk about chapter 9, which is forecasting exchange rate. So up till now, what we have done, okay, there are some theories, the exchange rate going to decrease or increase, but every theory has its own drawbacks. And remember, the exchange rate not only just depends on inflation or interest rate, there are other factors as well. Government controls, expectations, right? So then question is then how analysts forecast the exact exchange rate or the exchange rates, right? Because the parities we talked about and the interest rate parities, purchasing power parities, and international future effect, they all just explaining the exchange rate based on inflation, based on interest rate, and being based on both, right? So there are other factors as well, and that was the biggest drawback of these parities and interest rate and in international future effect, right? So there are some ways that are used to forecast the exchange rate. We can forecast for 3 months, we can forecast for semi-annually for 6 months, we can forecast for 3 quarters, 1 year, 2 year, 3 year as well. So if you go to Google or if you have apps, conversion apps, like exchange apps, so you can see over there, they always post some kind of like 3 years average, 4-year average for forecasting, or some good sites, they charge you for their premium services that, okay, if you pay us, we are going to educate you, okay, what's going on in next 3 months, in next 1 year, and what's going on in after 2 years or 5-year forecast, right? So that you can plan better, right? So let's just talk about the forecasting. So remember why we forecast? Because we want to manage our exchange rate risk, right? So the forecasting basically helps us to plan so that we can be free from any fluctuation in the market. So real exchange rates, they fluctuate even on second, on minute basis, on daily basis, right? So you can forecast, and on the basis of forecast, then you plan, okay, what we need to do. We need to do going for hedging, or is there opportunity for covering our position through forward or future, or there is some kind of like profitable opportunity to capitalize on the basis of parities or not, or forecasting exchange rate based on what's going on with the economy, because parities are just telling us about inflation and interest rate. So forecasting is very, very important. So the cost of MNC's operations and the revenue received from operations are affected by exchange rate, right? So at the start of this chapter, we talked about that we will be learning this international finance based on those companies whose business are in more than one country. So MNCs are a large group of companies whose businesses are not only just in 2 or 3 countries, more than 5, 6 countries. They are almost all over the continents. So their operations are already in one country. They have their plan. In other country, they have their sales operation, right? So like Apple Corporation, their plant and their major production is coming from China, Vietnam, Korea, right? So when they want to sell, when they want to import from there and want to sell here, then all the revenue will go back in dollars to the head office, then they will face a real consequences of the exchange rate risk, right? So therefore, MNC's forecast of exchange rate movement can affect the feasibility of its planned projects, and might influence its managerial decisions. We talked about hedging, and when we talk about the option contract, forward contract, we talk about some examples that how the planned project going to be affected by exchange rate and how we can deal with that. So MNC's revision of exchange rate forecast can change the alternative benefits of alternative proposal operations and may cause MNCs to revise its business strategy. So right now, the Apple has stopped its sales in Lebanon. Why is that? Because their currency has depreciated so much that they cannot, plan their revenues over there. So it's better to stop selling over there, right? So that is just latest news for you guys. So why firms forecast exchange rate? What are the uses of forecasting? Number one, hedging decisions. It's not like that tomorrow you need to pay and tomorrow you apply for hedging. No, because markets are becoming more efficient. So any information that is coming or that is leaking, it is included in the market, and on every minute by minute basis or daily basis, exchange rates are and forward premiums, they are revising, upgrading. So you plan in advance, right? So there are analysts who project the company's growth, the country's growth, right? And they talk about seasonal effect, and they add in their formulas or something. They make different, econometrics models, mathematical models, and they come up with the idea. Okay, it's better to go for hedging through options or through forward, and whatever cheaper for them, they buy in advance. So when actual things start happening, or when seasonal effects start, interrupting the market, so they are free from that, right? Their work is to receive the money, sell, buy cheaper raw material, and that's it. Their worry is not about managing the exchange rate. So they just, cover their positions, right? Short-term investment decisions. If MNCs or corporations sometimes have substantial amount of excess cash. So we talked about, our managerial accounting, and in our accounting stuff, we talked about the cash budget, right? Over there, we talk about, okay, there is surplus. So where we need to invest that surplus? So surplus is not in thousands of dollars. Sometimes those surplus are in billions or in millions, right? So cash itself cannot generate cash unless you invest, whether you invest for 1 to 3 days, for 3 months, it cannot generate cash itself unless you invest, right? So large deposits can be established in several currencies as well. Capital budgeting decisions. If you want to buy plant machinery, if you want to buy big, projects, you are constructing dam, you need a lot of machinery, right? And machineries are importing from different countries. So you need to be very careful regarding the exchange rate forecast, right, guys? So the uses of forecasting, they are used in hedging decisions, short-term investment, and capital budgeting. So what does it mean? It means they can be used to minimize the hedge. They can be used in short term. They also can be used in long run. And then earning assessments. So recall our discussion regarding the managerial accounting. We talked about the budgeting, in which we make also budgeted income statements, right? So from sales, we develop the production budget, and then we move on to the budgeting all other accounts, and then we create budgeted income statement and then budgeted balance sheet. So when you make the budgeted income statement, so you have the idea, okay, this year we would be receiving this much profit, right? So the parents' decision about whether a foreign depository should reinvest earnings in the foreign country or remit earnings back to the parent may be influenced by exchange rate forecast, right? If all the money that you received, if the requirement is that you need to revert it to your head office by 31st of December, and you realize through your assessment that things are getting better after 31st of December. So you say that do not remit the money right now, remit after 3 months. So you keep the money in local banks, in local currency, and after 3 months, when your assessments, your forecasts are really correct, and then you remit the amount to the head office, right? Long-term financing decisions. So MNCs can issue bond. Yes, they issue bonds. Normally, these are the biggest chunks of their long-term liabilities, right? So they issue international bonds as well. Bonds denominated in other currencies, in euros, in dollars, in Japanese yen, right? In pounds as well, right? So if they are paying back the interest, right, then whether they are paying more interest or less interest, because people will receive the interest rate. If 9% interest in pounds, people will be receiving 9% interest rate in pound, but you are paying in dollars. So you need to see the exchange rate, whether we are paying more dollars or less dollars. So in that case, you will talk about, or you will consult your finance department, especially the exchange rate department, and they will be telling you that, okay, it's better to pay through forward or go through future or choose options like that, right? So for